Hey guys, it's Jamin Coker with Secure Financial Management, and I want to get a quick video out to you about some things that have been happening in the market lately, and kind of combines with some of the questions we've been getting from clients. As usual, if we've been getting those questions from clients, probably a lot of you have the same sort of questions, right? So in the previous video, I talked a lot about how, kind of since the new year, actually since the day after Christmas, the markets have been on a great expansion. Until now. All right, suddenly Friday of last week we had a really big down day. Unfortunately, it's being followed into this week thus far, at least. and what has triggered that off, and we touched on this a few videos ago, is something that's come up called an inverted yield curve. And I've titled this this video, an inverted yield curve again, but why this one matters. Right? So the reason this one matters is there are different sorts of curves that can invert in the yield curve. And to take a step back, what are we talking about with an inverted yield curve, right? When we have bond yields, right, bond interest rates, there's different durations of bonds and different yields that associate with each of those durations. In a typical, normal sort of economic environment, lower duration, let's say a 3-month or a 2-year, those interest rates on those bonds would be lower than a 10 or a 20 or a 30-year duration bond. That's pretty normal, right? And that's easy to understand as well. Short-term investments, lower interest rates, you're going to be paid a lower interest rate for investing your money for a shorter period of time. You're paid a higher interest rate for extended investment time. Pretty simple to understand. But when we get into an inverted yield curve environment, it's an unusual situation where the shorter duration, like the 3-month or the 2-year bonds, those interest rates are higher. You're going to make more money on those investments than a 10 or a 20 or a 30. And it's strange, but it does happen occasionally. And historically, that has been a harbinger of a future recession. Not the next day, not the next month, but a recession typically 9 to 18 months in the future. And we did have an inverted yield curve of what we call the 10-year and the 2-year a few months ago, and I said, hey, it did invert. It's not really the yield curve that we look at as a predictor for future recessions, but it did invert. I said then what we really look at is the 3-month yield being higher than the 10-year yield. And that's what happened on Friday. That's what happened and caused the market to take a bit of a stumble. That's very typical. As soon as a curve inverts, it freaks everybody out. It seems like everyone kind of forgets, and then 9 to 18 months later we have a recession. So that's what's happened in the markets recently and what the markets are trying to digest right now. And often the question is, who cares? What's it matter if the yield inverts or the yield curve inverts? There's two real significant factors of why it's a big issue. Okay. First of all, it typically indicates a level of investor fear where they will go and invest their money for 10 years. They'll tie it up for a long time at a lower interest rate rather than invest it at 3 months at a higher interest rate. Like, why wouldn't you normally do that? Well, you'd invest it for a long time at a lower rate if you were concerned about economic conditions, right? You'd invest it at a lower rate for a longer time just for the safety if you were concerned about economic conditions. That's one thing, okay? The second thing is it tends to disrupt the flow of credit, okay? Our economy works heavily on credit, right? Most real estate purchases, most homes are purchased through a home loan. Some people pay cash, but not most, right? Buying a vehicle. Some people pay cash, most people don't. There's usually credit involved that helps facilitate that purchase. Banks borrow in the short term and lend over the long term. A home loan, 15, 20, 30 years. A vehicle, 5+ years. They'll borrow at a low rate and they'll go in and lend that out at a higher rate, right? So they can make a bit of money there. They can borrow at, let's say, 1%, lend it out at, let's say, 4%. There's a 3% spread they can make. But when short-term rates are higher, meaning the borrowing cost is higher than what it could be lent out for, why do you keep lending, right? And that's at a very high level what causes this inverted yield curve to be a bit of an issue. Having said this, it's something that we watch, it's something we're careful about. It doesn't mean that tomorrow a recession starts. It doesn't mean tomorrow that the stock market turns into a bear market, okay? It doesn't mean that. Typically it's 9 to 18 months out that we see these results flow through that can cause recessionary type environment. Okay, I wanted to share this with you because it's something that's come up a lot lately. Questions from clients, it's been all over the news. And I want to try and share that information with you as much as possible. Okay, please remember, guys, that nothing that we talk about here should be considered an investment recommendation. If you have any questions about your portfolio or anything that we've discussed today, please give us a call at the office, 210-428-6250. We'd be happy to speak with you. What? This? Aha, you got to watch future videos to find out about this. Talk to you soon.